All right. All right, we'll go ahead and start the presentation. And thank you everyone for joining us. We have participants from all over the world today, including presenters dialing in from Melbourne, the United Kingdom, with support staff operating in the background on the East Coast, and Dr. Garrick Heilman calling in from California. So truly global participation today, and we thank everyone for their help. It takes a lot of people to make these things happen. So some shout outs to the few people behind the scenes. Thank you to Sydney on our design team for work on the presentation, data science, and Tony specifically, and then Rachel, who works tirelessly to make sure we all get things coordinated here under the even hand of Jason. So thanks everyone for making it possible today. We'll go ahead and start the presentation now. I wanted to introduce myself. My name is Nicholas Carey. I'm the co-founder of blockchain.com, the founding commissioner of the Blockchain Commission for Sustainable Development, and the future, and the author of The Future is Decentralized. So thank you guys very much for joining us today. I'm very grateful for your time. We'll try and make sure we make good use of it. So the team at Blockchain has been very, very busy. And for those of you that don't know what we do, blockchain.com is the world's leading provider of digital currency software for things like wallets, our exchange. We have a data product where you can go explore what's happening on chain. You can borrow crypto and stablecoins from us. We have the fastest way to buy crypto in the world. And we recently launched interest accounts, which are incredibly special. And we have a big announcement related to that today. And we also have a world-leading API for all the engineers and software developers. So what's new at blockchain.com? So first of all, we have launched an accelerated ability for people to purchase crypto using credit cards globally. So we call it Simple Buy, and we've married that with Simple Sell. You can get you faster than ever with credit cards or our banking network, which supports dollars, euros, pounds, and the Turkish lira. We've launched fiat wallets as well this month for both GDP and euro, with more coming soon. Our Android app has seen lots of development, including the release of a really exciting security feature we call the cloud backup. So if you're on Android, make sure you've got your app updated. We've introduced a modal within the iOS app so you can see how much interest you're earning. And we've launched ETH packs and USDT deposit accounts for Android as well. And then the exchange has seen some significant UI improvements thanks to feedback we've gotten from our community around the world. And the new prices page on blockchain.com has seen a huge increase in traffic. And a lot of that's been thanks to the incredible amount of interest in crypto generally over the past 30 days. So if you haven't seen the mobile apps, take a look at those. They're getting updated about every 2 weeks, and it's always good to make sure you've got the latest version. So earlier this month, we made a really important announcement regarding our interest products. We launched one of the most significant retail interest products to date in the market, and not only did we want to offer something interesting, but we wanted to offer the best in the world. And so we've now increased the amount of interest we're offering on a variety of different digital assets. So if you deposit Bitcoin on your blockchain.com wallet, you can earn up to 6% interest, 5% on Ether, 12% on Tether, and 12% on Pax. These are the highest rates across the board and across the industry. So we're really excited to offer that, especially in this era of negative interest rates in traditional banking systems and bank accounts. So this is us making sure that you're invested in the future of the digital economy. You can be your own bank. Moving on, you'll see an updated user experience on the blockchain.com exchange. So we've been working with day traders and professional traders around the clock to improve this experience. We saw record volumes over the past 30 days on the blockchain.com exchange and continue to value the feedback we get. So get in touch with our team via chat. We're always here to help serve you and want to make sure we're doing the best job we can. Quick announcement on the exchange. We have now made it possible on both the exchange and the wallet side to have a dollar or pound denominated and euro denominated wallet. So that's a big deal. And then one more thing, so just to share this, we're really excited to talk about the launch of 2 new DeFi tokens that are currently available on the exchange. We made the announcement yesterday for deposits, and the trading pairs are live as of today. So it's now available for everybody. The YFI token and the Aave token are available on the blockchain.com exchange. So we welcome people to come test those new assets out. And thank you for everyone that's been advocating on behalf of getting new assets in the exchange. We definitely value your feedback on those things. So last month, we covered a recap of the monthly outlook on what was going on in both the macro and the crypto markets. We did a real deep dive into on-chain analytics, and we had a really special guest, Camila Rousseau, the recent author of The Definitive History of Ethereum. She interviewed all of the early participants and has told a wonderful story about that. So definitely go out and pick up her book when you get a chance. It was really great to have Camila with us. So today's focus, we're going to be doing again a market outlook, quick update on Bitcoin on-chain insights. Dr. Garrick Heilman has prepared a special presentation on the financial repression stealth tax, and very much looking forward to his insights today. And we'll be welcoming a special guest, Anthony Sassano from Melbourne, who is dialed in at the very early hours. He's a deeply passionate Ethereum supporter and community organizer. Has spent his entire career in tech, an avid gamer, and writes one of the most popular daily newsletters in the Ethereum community called the Daily Gwei. Recommend everybody read that. It's daily reading for many members of the blockchain.com team, and we're big fans. So very excited to have him joining us today. So without further ado, I'll pass on the mic to our very esteemed Dr. Garrick Heilman. So for those of you that don't know, Dr. Heilman is the head of research here at blockchain.com and one of the world's most cited cryptocurrency and blockchain technology researchers. He created and taught the first class on blockchain technology at the University of Cambridge and has authored leading research on cryptocurrencies, markets, stablecoins, and broader trends. He ranks as one of the 100 most influential economists in the United Kingdom, and his work can regularly be found on CNBC. He has research with the OECD, NPR, Wall Street Journal, and many more. So as usual, I'm very grateful to have Garrick joining us. Garrick, I look forward to your insights, and I think we'll be sharing the mic a little bit today, and then looking forward to our conversation with Anthony as soon as we get through a few first parts of the presentation today.
Great, thanks, Nick. So yeah, we'll try to move through this quickly so we can get to Anthony. And just briefly, when we look back at the price action in August, it was a strong month for crypto again. Bitcoin was up 3%, but Ethereum, and really driven by what's happening in the DeFi ecosystem, which we'll be talking a great deal about later, was the standout performer, up over 20% again, back-to-back months. Stocks continue to do great, up 7%, and the big loser last month was long-dated bonds, down 5%. And that's partly why we wanted to talk about financial repression later in the presentation. The dollar also dropped as well, continuing its recent declines. Bitcoin was on its longest or second longest streak above $10,000. It did dip briefly below that figure. But we've seen really strong crypto prices in general in recent periods, driven by the macro context, driven by what's happening in the crypto space itself. We are continue to be very optimistic, as we'll explore throughout today, about crypto's medium-term potential in this environment. I'm going to now hand it back over to Nick with some additional market insights.
Thank you, Garrick. So I wanted to share this chart, and we're debating whether or not to put this in because we have a lot to cover today. But one of our colleagues who we occasionally have on the monthly market recap, Charlie McGarrah, keeps a close eye on this chart. And so what you're looking at here is the price of gold in yellow and the CME Bitcoin futures open interest in blue. And so one of the things you've heard about Bitcoin maybe in the past is that it's digital gold. And so that thesis gets tested in the market on the CME open interest. And so the BTC futures here are basically a way for institutional clients to basically get exposure to crypto without actually having custody of it. So this means like traditional hedge funds, things like that. And if you look at the chart over the history of time, it's quite true that Bitcoin and digital gold, as in crypto of Bitcoin, have tracked very closely. That was until recently when we had the largest variance between those two since the CME began. So the very highly correlated aspect of the Bitcoin futures with the price of gold is certainly sort of kind of played out the narrative that Bitcoin may be a digital gold, and it's quite interesting to that crowd. But I think what's particularly interesting is as tech equities have sold off, the crowd appears to have meaningfully taken down their Bitcoin exposure, but the gold rally has stayed pretty constant. So if gold stays at the current levels or move higher, we actually expect the institutional customers to put more risk on in Bitcoin again. So we may see the price of Bitcoin trend back up against that line on gold. It's something we watch very carefully here. So that was sort of an interesting one, but that divergence in the futures was the greatest we've had and seen on the CME since the beginning of that exchange. So go ahead and move to the next slide, please. So what you're looking at here are the Russell 2000 in white, which is an index that tracks kind of small and medium-sized companies, the S&P 500 a little bit bigger, the NASDAQ composite, and then at the top, the purple line is the NASDAQ 100. So those are the 100 largest tech companies and platforms. And what you're seeing here is, especially in the past 6 months, NASDAQ has meaningfully outperformed the rest of the equity market. And that's kind of been true for a while, but it's speeding up and it's happening faster and faster, which really reflects the dominance of tech over the traditional economy. And COVID has certainly accelerated this by catalyzing an ever faster transition to the digital over the real. So we have this thesis we call electrons versus real world molecules, and it looks like the electrons are winning. So what's also notable, obviously in this chart here, is just how much the NASDAQ 100 has outperformed everything else. And so what we're seeing is a bit of evidence that the market is concentrating and betting on the larger tech platforms for the time being, and maybe discounting any antitrust enforcement that may come against some of those platforms. So basically the big tech is eating the little guys. I think that's super interesting in a world where we talk and think about crypto, especially as we are all working in the industry to make it possible for people to send precious information quickly and affordably over the internet, how important having a financial fabric for the internet is going to be. And so it's certainly something to continue to keep an eye on. But I generally think the NASDAQ 100, really leaning into the digital is probably really long digital and really short molecules. So we'll continue to keep an eye on that. The next slide is one I pulled up recently to do some research on. I wanted to better understand just how significant the wealth transfer that's happening between the capital formations of the large entities in the world and the average person that earns minimum wage. And what you're looking at here is the chart of how many hours it takes someone who is earning minimum wage to buy 1 unit of the S&P 500. And we're basically at record highs in terms of the amount of time. And this chart isn't even quite accurate because I couldn't find totally current research on this yet. But what we're seeing is that capital is concentrating significantly in pre-existing sources of capital. And so if you are earning a minimum wage, the markets have massively accumulated capital, pretty much to the detriment of people that are earning daily income through minimum wage. And so when we talk about inequality economically and the wealth gap, it's very, very visible in this chart. And so I think especially in this election season and with the concurrent crises of COVID, the economic recession, and the greatest social awakening since the civil rights movement, this type of waypoint is probably one to keep an eye on, and I expect policymakers to start talking a lot more about this, and especially aspiring potential politicians will be something to be pretty interested on. So without further ado, I'll pass things back along over to Garrick, who will lead us into the Bitcoin on-chain insights segment of today's presentation.
Great, thanks, Nick. So just quickly, in August, we saw slight declines in some of the on-chain activity on the Bitcoin blockchain in terms of daily number of transactions, down close to 3.5%. Our share of transactions dropped slightly as well. We talk about, we have a guest post in the monthly outlook, which we'll be publishing soon, from Into the Block, looking at the rise of wrapped BTC or BTC on Ethereum, something I'm sure we'll talk with Anthony about. I know he's written about this. It's interesting to see that happening alongside slight declines in transaction activities on the Bitcoin blockchain itself. But interestingly, we saw fees actually rise slightly in August in spite of that. So up to an average of close to $4 per transaction. In terms of country activity that we're seeing increases and decreases in August over July, some of the countries that showed the strongest increases include Ecuador, the Czech Republic, Brazil, Morocco, and Japan. And then on the decline side, we saw benign, if I'm pronouncing that correctly, I've not been there, Indonesia, Thailand, and Belarus, interesting, which has certainly been in the news for some of the unrest there, showing some of the biggest declines. When we look at the, just to come back to a price point, when we look at kind of various crypto price cycles, following the halving, we see that Bitcoin is performing really quite well. This is what we try to do, I think, with these calls, is we try to take more of a medium-term outlook and look at, kind of the historical context around price. It's always difficult, of course, to anticipate what's going to happen day to day, but we take a kind of slightly more medium-term view, and you look at how Bitcoin's done since the May halving this year. Its price is holding up quite well and tracking with previous cycles. So just briefly before we get to our discussion with Anthony, I wanted to talk about financial repression. This actually is the subject of my doctoral research. It's a topic I've been researching for a decade. It's not something that in my experience most people are aware of or understand the full mechanics of, but it's very, very important, especially as we head into a world with record-setting levels of debt. Even prior to the COVID crisis, we now see double-digit, percentage fiscal deficits in many countries, and there's growing discussion of financial repression. And the preferred term for policymakers of financial repression, you may have heard yield curve control. We're seeing some increase in activity there. But basically, the big kind of, what is financial repression? It's a complicated topic. We'll be discussing it and writing about it more in the coming months. But it's really about creating artificially suppressed interest rates. And this is very helpful if you're a government that's over indebted. The way a debt crisis can really spiral out of control for a country is if there's a sudden increase in the interest rates paid on a government's debt. And so yield curve control or financial repression is a policy framework for ensuring that does not happen, that interest rates stay very, very low. Of course, this has very serious implications for markets and for a number of market participants. And one of the things that we talk about in a post that is going to go out today, specifically on financial repression, is who are the winners and losers of the financial repression policy framework. And traditionally, one of the biggest has been traditional savers. People who hold savings accounts at banks really get liquidated in essence, especially if there's kind of above norm inflation. We saw Stanley Druckenmiller this week coming out and talking about his concerns about 5 to 10% inflation. The Fed was already committed to kind of letting inflation run a bit hot. And if you pair that above norm inflation with a policy of suppressing interest rates, you can see savers as well as bondholders and institutions that oftentimes get conscripted into owning bonds, such as banks or other investment funds, really losing out in eras of financial repression. This is certainly what happened in the post-World War II period, where the debt was in essence kind of liquidated away steadily through low interest rates and slightly high inflation. So many people are starting to say that's what we're going to see again. The thing that we wanted to highlight was that this is something that can be viewed as a bit of a stealth tax on savers, on participants who are either not as financially and economically literate, or who are conscripted or kind of forced to kind of own bonds. But crypto is potentially one of the big winners, of course, in this space. And decentralized finance and some of the crypto interest markets that are developing, which we estimate to have grown in recent months very quickly to approximately 10 billion in size now. So this is no longer just a tiny little segment of the crypto market, could really offer a solution to people looking to protect themselves from financial repression. But stealth taxes, the other thing that we want to highlight, and this is kind of getting into the political side of things a bit here, is there's been some support expressed publicly for financial repression as not only the most fair but most democratic way to deal with managing a debt problem. Gillian Tett, who's normally very reliable at the FT, recently made this claim that financial repression is fair and democratic, but we would challenge that. We think that any stealth tax, by definition, which is largely orchestrated by unelected technocrats, and really hurts the most vulnerable in society, the less well-off, less sophisticated, say savers using bank accounts, is not only undemocratic. It's not happening in a public legislative process, going through the traditional public forums of debate. It's being implemented, by central banks and whatnot. Is not only not fair, but hardly democratic. So we would challenge that view. And taxation without representation has been a rallying cry for revolutions in the past. We'll see if it becomes one as we head further and further into a new era of financial repression. So. Without any further ado, it's our privilege here to bring Anthony now into the conversation. As Nick mentioned, we're big fans of Anthony's newsletter, daily reading for myself and for others, and very excited to talk with him about the world of Ethereum and DeFi. Let me just stop sharing screen so we can see Anthony. Anthony, welcome.
Hey guys. Hey everyone. Thank you for having me.
Great. Well, we're thrilled to have you here. I think we've got a few kind of questions that we wanted to lead things off with, and then we were going to open it up for some questions from the audience as well. Nick, did you want to just start off with a couple of your questions before I jump in? Great.
So, hey Anthony, thanks for being up really early. I think it's 1-3 in the morning, or maybe 2 where Anthony is. So. Crypto never sleeps, and it's great as community members are awake at all hours for the cause. So thanks for your time. Anthony was really kind about a month and a half ago, spent almost an hour helping me get up to speed on what's going on, specifically within the Ethereum community, and also helping me better understand what's going on with something you may have heard about called DeFi. And so no stupid questions today, and we encourage anyone that has questions to definitely submit them, and we'll work to get those to Anthony in a succinct way. So DeFi, or decentralized finance, is making a lot of headlines right now, Anthony, and I think it might be helpful to define a few terms. Finance in general can be sort of intimidating, and so can you help us better understand what is DeFi and how is it different from everything else that's going on in crypto? I mean, people may have only heard about Bitcoin, they're learning about Ethereum, and now there's a lot of hashtags and people talking about DeFi. So, maybe put those 3 things in context for us, and we can start there.
Yeah, sure. So I guess the easiest way to explain it to people who may not be familiar with it is that, I guess, if you think about Bitcoin as a decentralized asset, you can think of decentralized finance as decentralizing everything else. It's got to do with finance, right? There's a bunch of different things being rebuilt on Ethereum, like your classic financial instruments like lending and derivatives and everything like that, and trying to decentralize this out. I try to compare it usually to, I guess, the traditional finance system, and people ask me, they're like, what isn't fintech doing this? The technology that's coming, that to the traditional finance system and improving that for a lot of people. But I push back on that because fintech is just building on the old rails that we already have, right? All these old systems that have been around for decades that are still quite slow. and it's just like putting band-aids on and trying to improve it. Whereas with, decentralized finance on Ethereum, we're rebuilding this from the ground up. We're rebuilding the rails that you can build these things on in a kind of global manner, in an internet first manner. So yeah, I mean, comparing it to Bitcoin again, Bitcoin is like, classically referred to as the internet of money. You send Bitcoin across globally. You can send it like really fast. You just have to wait for a block to kind of confirm. Whereas DeFi on Ethereum is basically decentralizing everything else, making everything else globally available, finance globally available to everyone, no matter where they are, as long as they have an internet connection. So I guess that's what people are most excited about, is the fact that we basically took the concept and the idea that came with Bitcoin and applied it to like everything else got to do with finance.
Great. That definitely helps me better understand it. And I'm going to probably borrow some of those metaphors. So I will credit you, but thank you. So we hear now a good deal about DeFi tokens. Can you walk us through what those are, what kind of the incentive mechanisms they provide, and maybe give us an example of one or two and the differences between them? The community members in crypto generally have, certainly had a large number of different assets put in front of them with varying degrees of, I would say, credibility. And so help us better understand what's going on specifically on the token offerings within DeFi and what the product market fit is for those.
Yeah, I think the best way to frame it is that people might be familiar with a lot of the tokens that were around in 2017, right? We had the ICO boom on Ethereum. A lot of these tokens were issued, and many of them were actually useless things. They didn't do anything, right? You didn't have like governance rights to the project. You didn't have like a right to the fees. The tokens were commonly referred to as futility tokens because they didn't do anything. Whereas these DeFi tokens that are kind of emerging and that have grown so much lately, they actually do give you rights within a system. So, for example, these different protocols on Ethereum, these different DeFi protocols, as I spoke about, like lending protocol, there's one for lending, there's like Compound and Aave, there's also derivative protocols. They tend to have their own token associated with them. And the whole point of this token is to basically decentralize the, management of the protocol through governance rights that the token holders have over the protocol, and other things like the rights to the fees in the protocol. Sometimes the tokens are used as an insurance for the protocol itself. So if for some reason the protocol loses money or it becomes under-collateralized or something like that, then the token can make up for that and act as like an insurance vehicle there. So I think most of the tokens that we're seeing within DeFi tokens have those two baselines: the governance rights and a right to the fees generated by the protocol. But there's a lot of experimentation still going on. There's different tokens experimenting with different ways to capture value. Some of them can be used as collateral within their own system. So there's a project called Synthetics, which is like a synthetic asset platform. You can actually use the SNX token of the synthetic asset platform to mint these synthetic assets. So you use that as the collateral to mint them. And that token will also have governance rights over the platform. It also has, and once you add it as collateral, you also have a right to the fees. So they actually have fundamental value now. It's not just these useless tokens that were issued and no one, you can't do anything with them within the projects that they were issued by. So I think that's like a surface level about why people are so excited about it. The other side of it, and this is probably getting a bit into the weeds, but the other side of it is that these tokens act as, I guess you could call them like a beacon for the community to rally around, right? So if you buy a token for this protocol, then you are immediately aligned with it. Just like if you buy Bitcoin, you are immediately aligned with Bitcoin, right? You want Bitcoin to go up, you want Bitcoin adoption to increase, you're incentivized to spread the good word of Bitcoin, for example. That's the same thing with these DeFi tokens, and it's always funny to me when I look at that, because like if I buy a stock like Tesla or Apple, like I'm not going around evangelizing that to everyone, right? Like I would Ethereum or some of these DeFi tokens. So that's where it's really unique to me, is that you can build an army of people around your project and give them real ownership over it as well, and a real say, just by having these tokens that are basically as free flowing on Ethereum as ETH is, or as Bitcoin is on Bitcoin.
Yeah, I think one of the biggest, there's this meme in crypto called the flippening, and it's always meant something a little bit different depending on who you're talking to. And certainly in the Ethereum community, there's I would say a hopeful anticipation of a flippening where the total value of the Ethereum network kind of absorbs the value of maybe some of the other dominant crypto protocols. And so how does DeFi in your view challenge the business models in crypto period? Like, what do you see changing there, and how should exchanges and wallets and lending businesses be thinking about the fundamentals of their business model in this era?
I think it fundamentally changes what these services are. So traditionally, these centralized services, like centralized exchanges, all of them will have been like, I guess, the one-stop shop for a lot of these tokens, right? You basically buy, in the earlier days, you'd have to buy BTC or I mean, maybe not so much ETH, but you'd have to buy BTC and then trade that for another one of these tokens, right? But now I guess you can use like direct fiat to a lot of these tokens as well. But the amazing thing, and what I've noticed recently, is that like these tokens get issued on Ethereum, right, for a project. They instantly start trading on Ethereum because Ethereum has decentralized exchanges on it. And then the centralized exchanges are actually the ones who lag to list this asset, right? We've seen this play out with Binance recently. They're like, obviously the biggest exchange still, like, I'm pretty sure, centralized exchange. But they're kind of like rushing to list these things after they've already traded like the hundreds of millions of dollars worth of volume a day on Ethereum, on these decentralized exchanges. So basically DeFi is now becoming the leader and that whole space over the centralized space, and they're playing catch up. Whereas previously the centralized space would kind of like lead, because you'd hope that your token would be listed on this exchange, right? And that it would go up in value because of that. But now you don't have to do that anymore. The YFI token, for example, the one that blockchain.com just listed, that was available on Ethereum. I think it's only 2 months old, but that did its entire run up to a $1 billion cap, mostly just through Ethereum decentralized exchanges, which is, fundamentally different to what we've seen in the past with a lot of these things.
Yeah, it's pretty astonishing. Well, definitely something to keep an eye on as we running custodial, non-custodial, and lending services here. So I'll pass it over to Garrick. I know he's put a lot of time thinking of some questions. So yeah.
Thanks, Nick. So Anthony, I just want to start off with, again, mentioning the newsletter, because it is such an incredible resource. And it's wonderful also for people of us who've been in the crypto space for a number of years to see all these great reliable sources of information and insights in the space. Now, that wasn't the case necessarily years ago, and I want to really direct the community to your newsletter. Can you tell us about it, including how to pronounce, for those who are new to Ethereum, the title, what the motivation for starting it was, who the audience is, etc.?
Yeah, for sure. Well, thank you for the kind words for starters on that. So yeah, the newsletter is called The Daily Gwei. It's a daily newsletter covering basically everything happening in Ethereum, or I guess like the top things happening in Ethereum for the day. And I guess the reason it's called The Daily Gwei is because on Ethereum, there's obviously you have to pay fees to transact on the network, and these fees are commonly referred to as gas fees or gwei. Gwei is like the without getting too technical, Gwei is one part of the gas fees transaction there. So that's why it's called The Daily Gwei. I started this newsletter about probably 2 or 3 months ago now. And I basically did it as a way to get my kind of knowledge out there, because I spend so much time in the Ethereum space. I talk to so many different people about things, like so many smart people about things, and they help me to synthesize my views on things. And I figured that why not, give this information out to the world? Like, there's so much value here that I could be giving to people and using my platform for more than, just posting snarky tweets. But in addition to that, I also wanted to start writing a lot more. And I figured the best way to keep myself, motivated to keep writing is to make a promise to like thousands of people that I'm going to write something every day. And that has worked, because I have not missed one. It's every weekday. I have not missed one weekday since I started. 77 issues straight so far. 71 issues straight so far. So yeah, that was kind of the main motivations for creating it.
Great. I just want to go back to kind of the start of the DeFi boom a few months back. DeFi has been out for a while, but it really went into overdrive this spring. Talk us through how that happened, and I think you already touched on some of the innovation that is occurring. This isn't just all of hype, but kind of walk through some of the innovations and that kicking off of the DeFi boom to where we are today.
Yeah, so I guess if we were to trace back DeFi's roots, I guess the first protocol that we referred to as like part of the DeFi umbrella would have been Maker DAO, and the DAI stablecoin, which went live December of 2017. Now, obviously, for those who were around in 2017, DeFi wasn't a thing. And even when Maker launched, DeFi wasn't like a thing. The term DeFi wasn't around. There was none of what we have today. Fast forward since then, it has been growing really slowly since then. I think also because we had the bear market through 2018 and 2019. The protocols were getting built and all this magic was happening, but because the market was like cold, people weren't so fast to put their money into things, right? And to put their fresh money into things as well. And everyone was hurting and everyone was bleeding. And the bear market, I guess, technically stopped at the end of last year, where we had that final kind of I guess capitulation, and then from there we started trending up again. And we trended up until I guess COVID happened. Then we had like a pause for a bit, but we're back on the uptrend. So I think that's helped considerably with the growth of these things. But they have actually been around for a few years now, for I guess a couple of years now. And in terms of like the exponential growth that we've seen, I think in June was when Compound launched what is now known as yield farming, if you've heard of that. They basically popularized this in June because Compound is a lending protocol on Ethereum. They have their own token called Comp. Now, what they did was to distribute this token is they're paying this token out to people who provide liquidity to the Compound platform. So if you go there and put in your ETH or put in your stable coins, they will pay you some amount of Comp depending on how much you put in for doing that. Similarly, they'll pay you Comp for withdrawing assets and borrowing assets too. And when I say they, I mean the smart contract system. This is all decentralized. It's not like the Compound company is paying you. It's all decentralized. You claim the assets yourself. You do it all yourself. And since then, it's kind of been a Cambrian explosion of this yield farming thing that we often hear about, where different protocols are paying out their native token for people to provide liquidity. So I think that's the main reason why we've seen it go from, I think it was $1 billion locked just a few months ago to like $9 or $10 billion today. But yeah, I think it was all there. Like all the ingredients were there. The market was better. Like this wouldn't have worked in a bear market, for example, right? It needed those kind of ingredients to be ready. So that's why I think we've seen the exponential growth. And now obviously more people are coming into the space and seeing the value in it. And we're having like this pace of development where we're packing hundreds of years of financial kind of innovation into like months, which is quite insane.
Great. That history is, I think, really helpful, especially for folks who are just getting into this. So one thing we wrote about recently is kind of a comparison of the kind of lending markets in DeFi and kind of what we call digital asset lending platforms like ourselves, like BlockFi and some others. Looking at the interest rates over the past 12 to 18 months, on Compound for a while, we were seeing double-digit interest rates, and then those compressed, and that may have driven people more towards the digital asset lending platforms, which offered, arguably an easier user experience, more predictable rates, higher rates even. But with yield farming, as you mentioned, it's made the returns quite compelling on the DeFi side of things. And I just wanted to ask you about kind of the user experience, the user interface, where that's at today. For people who are new to crypto and DeFi, is owning Ethereum the best way to gain exposure, or are there still relatively easier ways to gain access to this? And where does the user experience stand, and how does it become even easier for people, I guess?
Yeah, so the beautiful thing about Ethereum is that you only need ETH to get started. So if you've got some ETH, you pay transaction fees in ETH as well, just like you would pay transaction fees in Bitcoin on the Bitcoin network. So yeah, you just buy some ETH with your fiat money, and then you can withdraw it to your wallet, usually something called MetaMask for people that are familiar with that. Or there's a bunch of other mobile wallets you can play around with too, but MetaMask is the most popular desktop wallet. It's like a Chrome extension. And in terms of, I guess, the general UI UX, I think it's really good. I actually think it's better than the traditional system already. When I log into my bank account, I've got like, I hate it because, you know, there's so much redundant stuff going on there. There's so many wait times, and I see all these notes about things, and like, it's so confusing. And I log off, right? I'm just like, I don't want to deal with this anymore. And then I go on to Ethereum, and within like minutes, I am lending my assets on Compound, right? Or I'm borrowing assets from Compound or one of the other protocols. I'm trading my ETH for a stable coin like DAI or USDC, right? I'm providing liquidity for decentralized exchanges, from any number of assets, right? And yes, the UI UX is still clunky. There's for some of these apps, there's a bunch of jargon, like, you know, DAI, for example, like it's popular, but people still, when I say DAI, they're like, oh, what's DAI? Then I have to explain how DAI is like a stable coin, and they're like, what's a stable coin? So I think that the jargon is like still there. The UI UX is clunky for some of the apps, but you know, something like, I know I keep referring to it, but something like Compound, just, it's a very slick UI. You know, I work at Set, and we make a product called Token Sets. And that's, to me, very slick as well. So I just think that we're already ahead of where the traditional finance system is. I just think we have to refine those words so that we kind of remove the jargon and just say to people, hey, you can upload your dollars to Ethereum and earn a better interest rate than you could in your bank account. Just give them what they want, right? And give them a nice interface to do that. And that's actually going back to what we spoke about before. That's where I think centralized services can still play a role here, where they can actually sit on top of these decentralized protocols and, you know, take in the user assets and then lend them out, right, for them, on behalf of them. Take their cut or whatever, take their convenience fee, just like, you know, these centralized exchanges take their convenience fee for being a fiat on-ramp these days. So that's another angle that I'm hoping to see more of. And we're already seeing exchanges do this and other services do this.
That's great. Nick, I just want to make sure we allow enough time for any questions that are coming in from the community. I certainly have a lot more I could tee up for Anthony, but do we want to take some of those questions, or
yeah, we've got a few people, Anthony, that are following the DeFi stuff carefully. Would probably benefit from your perspective on things. So I think probably one of the most urgent ones would be to quickly summarize the sushi swap saga and drama going on there. And one person referred to it as, what are the benefits for DeFi from sushi vampire attack on Uniswap liquidity? So sorry to add the crypto jargon, but for those that know, they know. Can you give us a little rundown on what happened there?
Yeah, I mean, I'm not going to try and explain the whole thing because that'll take me a long time, and there's so much to cover here. I guess the simplest way I can explain it is that there's a protocol called Uniswap on Ethereum that is a decentralized exchange. Another kind of project came along called SushiSwap. It basically copied Uniswap exactly. It pretty much is the exact same thing as Uniswap, but added a token. So Uniswap doesn't have a token, and SushiSwap does. So, and as I mentioned before, with the yield farming stuff, you can pay out your token for people providing liquidity. So that's what SushiSwap did. They said, put your liquidity here. Actually, I'm going to get technical here, but they basically said, put the liquidity that you're providing to Uniswap in SushiSwap, right? And this was a calculated move, because what ended up happening is these people are earning sushi, right? They're actually getting some really nice gains from this, from providing the liquidity. And then the end plan was to basically, as was alluded to, do this vampire attack where they actually stole the liquidity from Uniswap and put it onto the SushiSwap exchange through a migration process. So, this is getting very in the weeds of things, but I think the main takeaway from this is that liquidity is not a moat on Ethereum. Just because your protocol has $1 billion locked in it one day, it can be gone the next. This happened in a week. SushiSwap went from nothing to $1.3 billion in a week, right? And then it took that with it when it created its own exchange, which is basically a clone of Uniswap. It took that directly from Uniswap to their own exchange. So it questions what is the moat, right? Like, how do you defend your protocol against these vampire attacks? Can this just keep happening? Is there diminishing returns here from doing this all the time? And, you know, SushiSwap has gone on and over the last day has actually done as much trading volume as Uniswap has. And Uniswap's been around for years. And one funny thing about this SushiSwap thing is that the creator of it assigned 10% of the tokens to himself, sorry. Then on the weekend, he sold it all, right? Basically for like $15 million in a week, and vanished, and then handed control of the protocol over to the FTX founder, Sam Bankman-Fried, for those who know him. And he's been kind of like taking the reins since then. But it's just insane. Like this is something that I think is going to influence how everyone develops their protocols now on Ethereum and their projects, because you've got to be scared of that, right? You've got to be scared of you build this thing for 3 years, 4 years, right? You deploy it, right? You've got all this cool tech that you spent so long on, and then someone comes along, copies all your code because it's all open source, right? Copies everything, shoves in a yield farming program with a token, pays people to move. And because liquidity can move so fast across Ethereum, you just don't have a moat. So that's the main takeaways, I think, from the whole saga.
Interesting. The drama is always fresh and distinct. I think crypto pushes innovation in really remarkable ways, and the businesses are always under attack in different ways. But this also creates interesting outcomes. They're basically one of the most adversarial markets ever. So imitation is the highest form of flattery, they say, but I think it can also be quite painful if you vocationally spent 3 years building something, have someone come Xerox it and take it from you, basically. So it's gonna be interesting to see how that develops. But with each one of those episodes, you get different incentives to build more resilient incentive structures and architectures. So it's savage, but it probably leads to better outcomes in the long run. Let's see. How would you comment quickly on the dangerous rise, I would say, on the fees in Ethereum really have clogged up the network. And for those that don't know, fees on cryptocurrency networks are a way to incentivize mining as well as other incentives. When there's a lot of people using a network, there can be congestion, and it can also cause fees to rise, which means the utility of the network gets diminished. And so I think Bitcoin has on multiple occasions had significant eras where there have been very high fees that lead to diminishing utility of the protocol, arguably. And Ethereum is now having a similar situation, mostly driven, I think, by all the DeFi activity. So what is the plan there? Like, what's your view on that? And it's obviously a sort of an endorsement of this is how useful and valuable the network is, that there's so many people on top of it. But it's a double-edged sword, because if it's not useful or it's pricing people out, that's also a problem. So what do you think is the viable pathway there?
Yeah, this is a hot topic in Ethereum and a hot debate. I generally take the side that on the short to medium term, high fees are very good for Ethereum. And that might be an unpopular opinion, but I've written about this before in my newsletter, but the main reason is because it pushes innovation on scaling, right? So if fees are really low, no one's kind of motivated to scale, right? They're just like, well, the fees are low. Why do we need to kind of scale? Why do we need to build these new technologies to scale, right? We'll worry about that when the time comes. Well, the time has come, right? The fees are very high because of the fact that, one, as you said, Nick, there's value there. People are doing valuable things on the network, and it's worth their time to do it and their money to do it. Secondly, it's because any rational economic actor is going to pay the fees as long as they're making more than what they're paying in the fees. So if they're paying $500 even to get into a yield farm, but over the course of a few hours they're able to make that back and then profit, then you would do it. I mean, I do stuff like this too, right? And a lot of people in the Ethereum space that I know, they do this. And for me, when I look at those fees, I don't even blink anymore. I just pay them because I know that the outcome is going to be profitable. But on the flip side, there's a lot of people that have been priced out now, right? If you don't have lots and lots of money for these things, then you're not going to be able to afford the fees. Even sending like a transaction is still cheap, but it's not as cheap as it can be. It's like a couple of dollars sometimes, depending on what you're sending. And that's where Ethereum, I guess, differs from Bitcoin too, in that different actions cost different amounts of money. So if you're just sending ETH across the network, it's cheap. If you're just sending a token, it's a bit more expensive, but still relatively cheap. But if you're doing like the stuff I talk about, if you're doing DeFi stuff, you're interacting with the smart contracts now, and you're interacting with more complex transactions. That's what's going to cost you a lot more money. So that's what most of the network is doing. But yeah, I guess there's a great blog post that I base a lot of my thinking on from Union Square Ventures that basically says that there's the infrastructure phase is a myth. The infrastructure doesn't come first, right? What comes first is the demand and the apps and the usage, and then we build the infrastructure after it. And you see that play out in the real world too, right? I don't know how it is in the US, but around me, they always build the houses first. They don't build the train stations, right? They build the houses, people move in, and they build the shops. They build the train stations, they build the schools and everything, right? And then everything goes up, but there's that for the people that first moved there, there's pain because they've got to drive like a longer distance to get to the shops. They have to drive to work because there's no train station, there's no buses, right? And that's just like what we are like on Ethereum today. We're we're the settlers, basically. We're the pioneers, right? We've come in. It's hard. It's got a long way to go. We have to develop what we've come into, but eventually it gets better. And that's what I'm kind of betting on with it. I'm betting on that Ethereum can scale through both ETH2, which people have heard about, obviously, and through layer 2 scaling on top of Ethereum. And we've already seen this explode over the last few months. We've seen more layer 2 innovation and development and deployment than any other time in Ethereum's history. And, ETH2 is going to take a little bit longer, but while we have like Ethereum as it is today, we can scale via layer 2. And now it just takes the projects adopting this, which they are slowly. So I think over the next few months, we'll see this happen. The fees will probably stay the same, and be high, but users will be interacting on layer 2, and that's how they'll save on fees. And one other thing I wanted to say, I know I'm rambling here, but this is really important. With Ethereum now, we're actually seeing these things pop up which pull capital together in a non-custodial way. So I mentioned the Wi-Fi token before. That token is part of the Yearn platform. Now, what the Yearn platform does is a bunch of different things. So one of its killer products are called vaults. So what these vaults do is it basically pulls all the capital together. So you can have 1,000 people put in $100 each for and this isn't expensive to do. It's like a few dollars to do, right? And then once the money's in there, it's pulled together. So then that pool of funds will go and chase yield on Ethereum, right? And go yield farm together and as part of one whole thing, instead of 1,000 users making 1,000 transactions to do yield farming. So it's like you're scaling up by pooling this capital together. And that actually is an underappreciated aspect, I think, because as I said, just think about how many transactions can be not prevented from happening, but can be offloaded to just that pool.
That's interesting.
That's
a shared transaction, basically.
Yeah, exactly.
Oh, that's pretty cool. So we just have about another 5 minutes, and wanted to see if there was anything else, Garrick, you maybe wanted to summarize or wrap up with.
Yeah, I'm glad you mentioned ETH 2.0, Anthony, and the transition to proof of stake and the opportunity to stake ETH. Can you talk a bit about that? The 32 kind of ETH staking minimum, and maybe touch on what that means for security and staking as a service, just to try to look further ahead beyond the current DeFi boom to what's coming down, maybe later this year or next year, hopefully.
Yeah. So the ETH2 rollout is being done in phases, and maybe many people aren't aware of this, but I guess what everyone's talking about going live, hopefully at the end of this year, is the first phase, and it's codenamed Phase 0. This is the phase where you'll be able to send your ETH to the new ETH2 chain. So it's being deployed as a new blockchain, and you'll be able to stake it there. And that's all you'll be able to do in Phase 0, just stake and earn a return denominated in ETH. And also you can't send your ETH back at the moment to ETH1. So it's a one-way bridge, which opens up like a whole different kind of can of worms for how exchanges are going to handle this, right? And with exchange staking, I don't actually think the top exchanges are going to be doing Phase 0 staking. I mean, by top, I mean like the Coinbases, right? The professionalized ones that are more, I guess, like in the US, not like offshore and things like that, because there are ways to do it where you can make derivatives of the token and trade those and things like that. But Yeah, I mean, without getting too much off track there. So yeah, phase 0 end of this year, you can send your ETH and stake there. As you said, 32 ETH is the minimum to be your own staker, but there's going to be staking pools, just like there's mining pools. So if you only have like 10 ETH, then you can basically pool it together with someone else and a bunch of other people to meet that minimum, and then you can stake. People who are familiar with proof of stake at this point, probably familiar with something like Tezos or Polkadot or Cosmos, which is delegated proof of stake. It's different. It's when you literally just put your tokens in. It's usually on an exchange. You put it in, and then you let the exchange take care of it all for you, right? That will be able to happen in ETH2 as well. But the difference with ETH2 is that anyone can be their own staker with or without the minimum. So you can run the staking software on your own computer and your own home. Like I've got my own dedicated computer for this, and I'm running like the test nets on it and things like that. And it's not beefy. It's not like a miner. You don't need beefy hardware or anything like that. You just need like some simple hardware. You can even run it on a Raspberry Pi, I think, in the first phase. Anyway, and then you'll be able to stake on your own. Whereas with these other protocols, you don't really have that option. You have to delegate your stake essentially. So that's what's coming with phase 0. And then we have phase 1, which comes after that, which for people who have heard about sharding. So the shard chains that will connect to I forgot to say, the phase 0 brings with it what's called the beacon chain, which is basically the staking chain, and then the shard chains will connect to this beacon chain. So that's what's coming in phase 1. And then we have phase 1.5, which is when ETH1 gets merged into ETH2. So it becomes a shard of ETH2. And then phase 2 is when we get basically full smart contract capability across all the shards, full what's called state execution. So you can actually do transactions and things like that. So it is a kind of like a complicated roadmap if you want to dig really deep into it and how it all works. But it's going to take probably a couple of years to get this all out there. But I think for most people, the only thing you really need to be concerned about is, do you want to stake? Yes. Okay. Well, there's guides already out for how to do this and everything. You can Google search the Ethereum Launchpad, I think it is, or Ethereum Foundation Launchpad, and that'll guide you through it when it goes live. Or do you want to, or don't you want to stake? Well, if you don't want to stake and you just want to be on Ethereum, you just have to basically do nothing, because once that merger happens with ETH1 into ETH2, you ideally, I mean, if everything goes well, which we hope it does, you won't feel a thing basically. You'll just be part of the ETH2 kind of network now. The network will feel the same to you because we're preserving the ETH1 network, but it's just going to be secured by the proof of stake chain instead of what we have today with mining. So that's like the whole, I guess, roadmap there. If you want to read more about it, there's plenty of resources online. You can search ETH2 phases and it'll come up with resources. But yeah, it's pretty exciting in my mind, because ETH2's like the staking that they're trying to do in the whole architecture is very different to what the other protocols are doing. In that, to me, the other protocols are taking trade-offs where they're taking shortcuts and using this delegated proof of stake mechanism. Whereas as I explained with ETH2, they're using like a self-sovereign kind of staking mechanism where you can stake on your own, or you can stake with an exchange if you want to.
Great. That was brilliantly succinct for something so complicated. One last question, if we can, Nick. And you started to touch on this, so it's a good way, I think, to wrap up. And I know you probably get this question a lot, and the challengers to Ethereum, the other protocols that are trying to beat Ethereum, what would it take to beat Ethereum? And maybe you could talk a bit about the Ethereum community here at this point too, and how that plays into kind of Ethereum's moat and its advantage.
So I'm a strong believer in that if you don't have a community, you're not going to even touch Ethereum. Like very, very strong believer in that. Just like with Bitcoin, right? No one can touch Bitcoin because their community is so big, right? So large, so feverish. It's the same with Ethereum. So that's the first thing you need to do to come at Ethereum. You need to have a really good community who cares deeply about the project, right? And about what the vision is, and have kind of an ideological view of where they want kind of this thing to go. And that's what a lot of the people in Ethereum have. That's what I have. That's what I'm here for. Like, I'm aligned with the Ethereum vision, which is to, decentralize everything basically. And then on top of that, you kind of need to basically build everything that Ethereum's built at this point. You need to build all the DeFi stuff from scratch, right? You need to build you need to have all the assets as well. Like, the assets are the most important thing, I think, in that you know, all these assets that people want to trade are on Ethereum right now. Like, and any of the ones that are not on Ethereum are being tokenized on Ethereum. Like Bitcoin is being tokenized on Ethereum at a rapid pace because people want to use their Bitcoin to do things, but they can't do that on the Bitcoin network, right? So they come to Ethereum and they do it on there. So that will be the second most important thing, I think, is the assets. And this all plays into the network effects, right? You know, dev tooling, things like that. You know, developer kind of like, I guess developing on Ethereum in general is a lot easier than probably other platforms, because say you've got like a question about something that you Google search for, you're more than likely to get an answer to it on Ethereum. But if you're developing on one of these new chains, you're probably not going to get an answer to it from Google. You're going to have to go into like the channels and speak to someone directly, and the response might be slower and everything like that. So, you know, you just default to that as well. But I think from the conversations I've had with people in Ethereum and what it would take for an Ethereum to change, right? It would have to be one of two things. It would have to be a shift in kind of what these other platforms are doing in terms of like their ideologies and their goals and their vision. The other platform would have to basically be as decentralized as Ethereum, which none of them are objectively at this point. I'm talking smart contract, not including Bitcoin in this. They would have to be, and they would have to have the ethos and the spirit of Ethereum, where I don't think any of these others do right now, because Ethereum has a long and colored history as well, which plays into things. So it's kind of like changing cultures to an extent, right? If you were born and raised in one culture and then you try to go and change it into another one, it's very hard, and most people don't do that because it's hard and it's alien. It's doesn't align with who you are. And you can even compare it to like, I guess, like a religion too, right? Imagine changing like your faith or what you follow. It's very hard. And that's what these are to me as well. Like it's pretty much at that level in people's minds, I think. So yeah, without, I guess that's maybe a different answer than you'll get from other people. But for me, who spent so much time in this whole space, community, yeah, and all that stuff that surrounds community is what you need to even scratch Ethereum. And right now, the other platforms can't even come at Ethereum because they're all fighting each other too, right? For a chance to be number two. Like if I asked anyone what's number two to Ethereum, right, you'll get different answers from everyone. You won't even get this. You won't get the same answer. So until you can actually get the same answer from multiple people, multiple different people, then I don't think anything can come close to Ethereum at this point.
Wonderful, thank you. Well,
all right. Thank you very much, Anthony. I think we'll let you get a few hours of sleep. Surely you'll need those to maintain the stamina long term. We really appreciate your time today and always value your insights. Please look up Anthony's newsletter, subscribe to that. We'll put a link into the description of this so that people can find it, Anthony. And so everyone, thank you very much. We'll be uploading this to YouTube, to Facebook, and we'll be announcing also a podcast soon, so stay tuned, and we'll catch you next month. Thank you, everyone, for joining us again. Have a wonderful morning, afternoon, or evening. Cheers.
Thanks, everyone.